Hello and welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman & Co. And I'm joined today by Dr. Martin Hall, our life sciences analyst. Martin's had a distinguished career in the city, analysing life sciences since 1987. Great to have you here today, Martin.
You're welcome.
Now, Martin, you just published your annual report on the Hardman & Co. Healthcare Index. This index has been running since 2009, and its main function is to chart the course of life sciences investments over the long term. Can you summarise the salient details, please?
Yes, indeed, Keith. After 3 consecutive years during which we've seen some declines in the healthcare index, which we abbreviate to HHI, 2025 was characterised by a rebound of 17.6 in the index. Now, although this sounds positive and was very welcome, it was still below the strong performance of most major UK healthcare stocks. And in general, it underperformed its UK and peer benchmarks, which of course is a little disappointing. But as you say, looking over a longer term from inauguration in 2009, the index has generated a compound annual growth rate of 10.3%. Now, in 2025, we were forced to make some changes to the constituents, mostly caused by M&A activity, but also through some delistings. And our index covered 49 companies, and 19 of those saw an increase in their share prices in 2025. But in relative terms, only 13% or 27% of the stocks outperformed the index. So this suggests to me that there is common knowledge that several companies in the index are in need or were in need of additional working capital. And it tends to happen that their share prices are marked down in anticipation by the market.
Yes, thank you for that. So yes, it's well known that this industry can be very capital intensive. So has anything changed?
Well, when I started 38 years ago, there were many more institutional investors, and nearly everyone had either a specialist healthcare team or a specialist small capital team. And often they had both. Now, extensive consolidation with the investment community, increased regulation and risk assessment with pension funds, and a vast increase in wealth being invested has resulted in a smaller number of groups with enormous funds under management. Consequently, their interest in small caps has evaporated, and they prefer to use alternative investment funds for their involvement in this space. Literally, only a handful of UK institutional investors still have specialist healthcare analysts today, which is something that I've been highlighting for a few years now. So when a small cap healthcare company does need a capital increase, their options with institutions are very limited, and they're increasingly reliant on a pool of private investors. Now, during 2025, we recorded 38 healthcare companies that raised a total of £266 million at an average discount of 22% to their share price at the start of the year. Now, while the number of companies issuing equity were the same, the quantum of cash raised was down 52% on 2024, and the average discount was 4 percentage points higher.
So that raises the question of whether the need for capital has caused awkward situations to arise.
Well, unfortunately, Keith, the simple answer to that is yes. And it was replicating something that we observed in 2024. Oncommune appointed administrators in March when it couldn't raise any more working capital from investors, and because they had basically felt badly let down by the management team. Additionally, we saw 5 companies delisted from AIM, their board of directors unwilling or unable to raise capital at extremely depressed valuations. So they've decided to try and tap the private equity or venture capital markets. In fact, we believe that such activity is likely to be repeated again in 2026.
Is further capital going to be required in 2026?
Again, the simple answer to that question is yes. And to date, what we just towards the end of January, 3 companies have already approached the market for more capital, and more are expected to follow in order to get their accounts signed off by auditors.
That's a good point. So last year, I recall that you highlighted that increasing working capital was needed for the commercialisation of products. How did that pan out?
You're correct there, Keith. We highlighted in the report last year 12 companies that we expected share price movements to be dictated by news about progress in commercializing their regulatory approved technologies. We didn't really have to wait long for news to emerge that sales performance was well below expectations, resulting in cuts in forecast guidance and putting pressure on their cash positions. Now, of those 12 companies that we highlighted, I would say only Shield Therapeutics managed to deliver product sales close to market forecasts and end the year being cash generative. Now, this was achieved on lower than expected volumes, but at markedly improved prices. So on revisiting that table, we would argue that 10 of those original 12 companies are still in the same commercial position that they were a year ago, but now with weaker cash balances. Only Tristel in the list has a strong underlying business and balance sheet while it tries to get commercial traction for 2 products in the United States. As far as Futura Medical is concerned, we're even going as far as suggesting that Haleon will try to get out of its commercial arrangement for commercializing Eroxon in the US. So overall, it remains a very difficult picture.
Now, 2 parts of your latest review caught my eye. You questioned yourself about comments and recommendations that you've made in the past. That's quite unusual. Could you expand on that?
Yeah, as I stated in the document, I've always been very conscious of my recommendations and opinions on companies. However much research you undertake, there can always be something unpredictable lurking in the background that completely alters the course of a share price. On Glaxo, or GSK as it's now known, when Dame Emma Walmsley was appointed CEO, I openly published that in my extensive experience as an analyst, the appointment of a person with a marketing background to head up a pharmaceutical company was inappropriate, and it was largely due to their lack of scientific knowledge. I could cite many occasions where this has ended in tears. With Dame Walmsley, this view was exacerbated by the fact that her marketing experience was actually in consumer brands rather than drugs. So when the announcement came that she was stepping down back in 4th quarter of last year, I felt that I should ask myself if my criticism of her appointment was justified. While I would acknowledge that Dame Walmsley has achieved much at GSK, notably, of course, the demerger of Haleon, the simple fact is that GSK shares have underperformed their global peers by 70% during her tenure. And even allowing for the Haleon in-specie dividend that shareholders received as a result of the demerger, the enterprise value of GSK only rose 6% in nearly 9 years. So I would argue that this performance speaks for itself. Now, Tissue is a very different situation. I followed the company's development for over 10 years. And for a number of those years, when TRX was a client of Hardman, I wrote regular research, albeit this contract was terminated just over a year ago. So consequently, when the company announced that it was almost insolvent in November and in need of a financial lifeline, I did ask myself if I had missed anything in my analysis. So I included a detailed review of the specific area directly responsible for its financial difficulties, and I would argue that it did not throw up any red flags at all. Moreover, This area was specifically highlighted and noted in the accounts by its auditors. Therefore, it would be reasonable to expect that revised inventory estimation methodology would have been an area of focus during the audit, particularly as it was disclosed as a critical accounting judgment. I think analysts have to accept in good faith that audited figures are materially accurate and a true and fair reflection of the business. Consequently, we would contend that the issues that arose at Tissue Regenix in 2025 would be extremely difficult for an analyst to identify in the normal course of their research. And I think that this latter example highlights my original point to your question, that we as analysts need to be wary that there might be something unpredictable lurking in the background for all companies. But I also think that it remains important for us to question ourselves when something goes wrong.
So what's your take-home message then, Martin?
Well, despite some of the performances, we still believe that there are some great healthcare technologies in the UK. However, these need extensive development capital to satisfy the regulators. And even when that regulatory approval is achieved, considerable investment in sales, marketing, and the right management team to get the products and technologies established in the market. As we highlighted last year, there is an ever-diminishing institutional interest in small-cap healthcare in the UK, despite the good returns that we've seen historically. There are many examples in the market today where the valuations are well below the cost needed to get the company developed to where it is today. And that's resulting in several boards of directors taking the decision to delist their company. We are even more concerned that our warning in 2023 about the future existence of healthcare sector in London is not being heeded. And as we saw at the end of last year, AstraZeneca looks as though it's going to move its primary listing to the United States.
Martin, thank you for sharing those enlightening but truthful thoughts with us. You'll find more detail on these topics in our report, which is available for free on our website. That's hardmanco.com. As always, thank you for watching. Please don't forget to like this interview and join in the conversation wherever you're listening or watching, and we'll see you next time.